and welcome to the Build and Exit podcast. Welcome, everybody. Thanks for listening to us. My name's Julie Wilkinson, and I'm the owner and founder of Wilkinson Accounting Solutions. I started the Build and Exit off the back of the work we do in Wilkinson's because we help people with acquisitions and exit planning. And I saw there was quite a gap in the market of financial understanding when it comes to buying and selling businesses. So we've had lots of interesting guests, and I'm really excited today to have Mathew Wainwright with us. Hi, Mathew.
Hi, Julie. Thanks a lot for having me on your podcast.
You're welcome. Thanks for coming. You're a very great guest. So I do get funny with this name. So Mathew is one of four partners in Opulentia Capital. It's a bit of a tricky name, so I think I got it right. Been partners for 3.5 years. Looked at 15 acquisitions, group turnover around 125 mil. The premises of what you seem to do is leverage buyout, so minimal equity down. So I think it's going to be a really interesting topic because I know everybody's looking for no money down deals, as they like to call it. So first of all, let me hand over to you and introduce yourself.
Yeah, thanks a lot for that, Julie. So I think my journey in regards to my personal background, so I was born and raised in Spain and moved over to London. And while I was in London, my entrepreneurial spark started, coming out while I was at university. And that's at the point in which I was starting out doing a bit of e-commerce work on the side while I was at university. Found out that was really hard to pretty much build from scratch because you don't have employees, you don't normally have a lot of capital, you don't have a lot of resources to yourself. And I got exposed to what is M&A, right? So a lot of people call it a hack when buying businesses because you can, buy turnover, you can have staff that is already being trained, hired, is already working within the business. So I kind of started getting a lot of interest in the M&A world at about 5 years ago now. So it's been 5 years since I've been focused on M&A. And over the last 3.5 years, as you very well mentioned, I've managed to close 15 companies. They've all been leveraged buyout transactions of profitable companies that, were looking for some kind of succession plan in place. We provided that through a structure that we can go into within the podcast. But it's been a really great journey. I've been exposed to 8 different industries so far. I've learned tons throughout the process. There's a lot of details that go into just getting one deal done, which I think is really important for the audience to understand. A lot of skill sets, which is why, Julie can be a really important resource when looking at buying a company. But I guess I look forward to going deep dive into how we go on about getting deals done, essentially. So.
Yeah, definitely. I think where it'd be good to start is for people that don't know the terminology. When you say leverage buyout, maybe explain a little bit about what you mean and how you do it.
Yeah, so a leverage buyout is an acquisition of a company that gets done through debt plus an equity component, right? So back in 1980s, it was a terminology that got really famous, especially in Wall Street, for buying asset-heavy industries with a lot of debt. And they would structure the acquisition, and then within 2-3 years, they would refinance that deal, make a bunch of money, and everyone was happy at that point. However, it does also have a bad terminology because a lot of the deals that happened back in the day used to go wrong. So it's an acquisition structure that uses debt, uses a bit of equity. In our case, not necessarily that much, more or none at all from our part. But it's a very common, I guess, acquisition process in the M&A world for those who don't understand.
Yeah, definitely. And I think, what's going to be interesting, we're going to have a look at cash flow today because obviously that's the biggest thing that causes problems in businesses. I know from my perspective, from the people I speak to in the acquisition world, leverage, but I think a lot of people just call it no money down deals. And when they say money down deals, they're looking for kind of like heavy asset acquisitions where they can leverage off that to get the financing. And what I just tried to say to people is it's okay doing that, but that doesn't mean you don't need any knowledge of running a business or any risk strategy, because at the end of the day, once you've maximized the funding, what happens when you need funding for working capital? I'm not saying it will happen, but I think you have to be prepared. So I think you've obviously successfully done 15 of these. So it'd be interesting to see your take on how you're planning and you're managing your cash flows.
Yeah. So I think first of all, when people say about no money down, it's not that the owner is not getting any money for the business. He is getting money for the business, but it's just, does it come out of your own pocket, right, as an investor, or does it come through other sources? In our case, in this case, we utilize personal relationships, and we utilize financial institutions such as HSBC, Barclays, the big ones, and we also work with the boutique firms. So when we look at making an acquisition, yes, we do look at asset heavy industries. We look at companies that have a low debt to asset ratio. This means that when we look at a company, and when we look at refinancing the assets so that we can, I guess, generate a bit of cash for the upfront consideration, we've got a good opportunity to offer a good amount of cash upfront for the business owner day one, with some kind of seller financing option together with that initial cash consideration. So it comes down to understanding the asset types that you've got within the business. It also comes down to arranging terms with the seller that make sense, and then also obviously projecting the cash flows and the risks that come out of that acquisition. I can go into Julie. I can go into how we try and mitigate those risks and the things that we look at inside companies.
Yeah, definitely.
I guess when we manage businesses, we want to see the working capital needs. We want to see who owes us money, and we want to see who do we owe money to. That's how we manage the businesses within our portfolios, so that we can keep track of them properly. Now, in order to understand the working capital needs, we look at the total revenue generated, right, minus the cost of goods sold, and that gives you a rough estimate. We also project the working capital needs based on the average of the last 3 years, and we project the need for repaying the interest on the new debt that has been injected inside the balance sheet, plus obviously the cost of the principal plus the interest, as well as this seller financing. So we first of all look at the working capital needs, we calculate that, then we project the cash flows, we look at what the cost of borrowing is, what the payment terms are on the principal, and then we also project the seller financing note that will be paid over normally 3 to 5 years. And based on that, we need at least a 50% debt coverage ratio, which means that if the business were to lose half of its profits, it would still be able to pay its debts when they're due, essentially. Okay. Those are the main factors that we look at financially when we look at analyzing the financials of a business. We also look at the risk of the customers. So we check the customers, and we get some good references from them. We also look at the customer concentration within the businesses. And we also project, what the future costs are going to be from having employees within the business. So obviously there's a massive cost of living crisis going on right now. There's an inflation. The cost of materials is going up. The working capital needs will also grow if we grow the company together with the employees. So those are components that we also look into and we take into consideration when looking at, I guess, properly analyzing the risks of managing a company. So yeah, it's a very detailed analysis, I would say.
Yeah, it's music to my ears. I mean, this is all the things that I love because I'm a geek. But yeah, so yeah, we do. I mean, this is what we focus on when we work with people at Wilkinson's, because I think it's having the right support, isn't it, to build the models. One of the things I see, and this is why I talk about a lot, what are the owners doing in the business? Are the current overheads, correct for the business, even the business now? I mean, you'd be surprised how many, well, maybe you're not, but it's quite surprising how many businesses actually are kind of understaffed already and the owner's topping up the work. But I suppose the problem is when you come on as the owner and you don't want to do that job, or you can't do that job because you're not skilled in it, straight away your profits are dropping. So there's a calculation, isn't there, of excess working capital now, but what's the real working capital for the business?
Exactly.
And how do you then negotiate that? I'm not saying you wouldn't buy it, because if you've got a good team around you and it's a good business, it just comes down to negotiations then, doesn't it, with the seller?
Yeah, totally. I think that the work that you guys do at Wilkinson's, it's just crucial, right? Like if you can track the money within the business or the financials within the business. It's kind of like you control the organs within the body, right? It's what makes the business run at the end of the day, and it's really important to take a lot of things into consideration. We actually started out, Julie, talking about that with an outsourced finance function, very similar to how you guys run right now. We have obviously transitioned into bringing everything in house and having our own CFO and our own financial analyst. But for those people starting out, I would definitely recommend having a really good detailed cash flow forecast of the businesses as you progress, and having, I guess that external person that can look at the business with their perspective and with their experience. So definitely, yeah,
Yeah. And I think you've done the right thing. I mean, what we tend to do with businesses, because we do tend to work on multiple deals, we know really when you get to about deal 4, you do need some form of finance team in house. That's one of the things that we do at Wilkinson's. We do actually help people recruit, train, and onboard finance staff. So we'll set the modelling up so that when the FD comes in house, it's all ready. And we know that that's quite sought after because finance teams like coming into things that are in place. If people come into messy situations. And then we just see the need. I think what happens in my experience, because obviously I've worked in finance teams before, I've worked in corporate, I've worked in these teams as well, I've done systems and things like that myself, systems and projects. And I know that what tends to happen is if you're doing lots of different projects and deals, sometimes the finance teams become too overworked, and then you might not need a finance person in house for deal 5, say, because it's too expensive. But actually when you get to deal 8, you do. And I suppose that's where I think the outsourced finance works well, is it bridges that gap between when do you need the resource in house to when do you actually keep it outsourced.
Yeah,
so
totally. I think it's, as you said, like setting the foundations for maybe the future finance team that goes in house is very important. In fact, a lot of the businesses that we buy, you would be amazed by multi-million-pound turnover businesses that don't really track their accounts on a monthly basis. It's amazing to me how they make money, but they do. So yeah,
yeah. Although, well, it doesn't surprise me because I see about 100 balance sheets a month. And actually, when I started Wilkinson's, I did a survey and I asked 20 businesses of all sizes from about 50,000 turnover to about 20 million, and 100% only saw their accounts once a year. I was a bit shocked back then because I wasn't in practice then. I was in corporate, but it doesn't surprise me now. But what you'd find, though, the risk is, this is why people struggled in COVID. Because people manage, but that's because they're generally living off other people's money. So they're using their VAT money, their tax money, which I'm not saying is a problem, because at the end of the day, that's how we all manage our cash flow, is to utilise our cash at the right time. But when it is a problem is when something happens. So that's why when COVID came and businesses stopped, it became a problem, because everyone had already used all the money. So therefore they now had no money to pay their debts. And because obviously your tax and your VAT in theory is just a debt, because it's cash collected that you owe. So it is something important to look at, I think.
Yeah, and I think if you were to empathize with, say, a typical business owner that has got, say, 1 million in the bank, the salaries are, say, 100K per month, let's say. I mean, you've got enough working capital for the salaries, right? So it's not something that just really that is really urgent to solve, because you've always got cash in there. But if you want to professionalize the business and you want to have like a bird's eye view of where you're at within your year, I think that at that point it becomes extremely important. And as you mentioned, any emergencies that come up, I mean, if you can't, if you don't have a bird's eye view of where you're sitting, it just makes financial decision making at least a lot harder at the end of the day. So
yeah, my experience is, if you're just doing the same thing every year, in a way you can just maintain. My experience is it becomes a problem when either a scenario happens or you're trying to expand. That's when the problems come, because when you need an influx of cash, you have no methodology to track it. So if you're just doing the same thing every year, like you say, with your fixed overheads and your small growth, just your organic growth, although you probably should be analysing it, you can probably work it out enough to maintain, but it is when you want to do something that it becomes a problem. My experience
and
anyway.
Julie, what's your take on dividend payments? So dividend policies within a company. Let's say a company has made 1 million in profit, right? It is looking at growing within the next few years, and it is going to need a bit of extra working capital, but the shareholders want to pay themselves. What's your perspective on that consensus?
Yeah, so, well, I mean, I think a lot of people don't really understand the dividends. So the fact is, when people pay themselves through the business, if they're not paying a salary and they're paying what they class as dividends, the reality is legally it's not actually a dividend at point that payment leaves the bank. It's actually a director's loan. And the reason is because you have to have enough retained profit to cover the dividend when you come to declare it, which is usually at the year end. Most people declare at the year end. So there's nothing wrong with paying the dividends, but what often happens is people overtrade. They did it a lot, especially with the CBILS loans and the bounce back loans, because people have excess cash through things like VAT collection, tax collection, loan collection, but actually that's not been generated from the working capital. So the bank balance, so it's interesting because the £1 million in the bank example you gave, actually, I've seen people with £1 million cash, but you take off 18 months worth of taxes, 3 months of VAT that they haven't paid, and I've seen it drop to way under 400k. So actually they don't have $1 million. Their actual free cash is X, and that's not even the working capital. That's just taxes already due, because they're not accounting for it correctly on the balance sheet. So it's making sure you don't overtrade, basically. So that's why you've got to be tracking it. At the end of the day, there's things you can do to mitigate it, but if once you get to the point you've done it, it can be difficult to reverse it. That's the problem, and then you're using all your money. So.
Totally. I think one of the key things in my experience at least is to actually calculate the free cash flow and just make the I guess dividend decisions from the free cash flow as opposed to just the P&L, because it can be, as you mentioned, very tricky with new payments that will come along over the next few months that you don't account for, sorry, as of right now. So definitely.
Yeah. I mean, my view is I don't think sellers work on adjusted EBITDAs often enough. I mean, we look at it in our business, you have a trading margin, and then so you have an operating margin, and then you have a adjusted margin. I think every business does, because everybody does have some form of one-off costs that aren't ongoing. And so as an example, where the dividends cause the problem as well is the cash flow and the tracking is one problem, but it's also where is the P&L. If they're taking dividends, they're not actually reporting the salary, which is fine for tax purposes. And I'm not saying you should pay it as a salary, but it is quite easy to offline adjust your P&L every month if you've got the right financing in place to go, okay, so this is my trading margin, but what's my operating margin? And it's fair both ways, because if you have a one-off cost, let's just say you had a legal bill that you had to pay that was 20 grand, and your operations are being targeted on their performance, is it fair for them to get a lower commission because you've had a £20,000 legal bill that's got nothing to do with them? So I think people should be tracking adjusted margins in general anyway, because as long as it's not that complicated, it's because people don't. So then the question comes, when they are paying the dividends, is the P&L got the right profits, the right costs in for those salaries as well?
Makes a lot of sense.
Yeah. How do you guys analyze that? I mean, how do you track that?
So we look at the free cash flow most of the times, and we do also project I guess the where the future is going, what the working capital needs are going to be like within the business, and then from there we make a decision. Normally we have a dividend policy. We're calculating it now that about 20% of the profits will be distributed as dividends to the different shareholders within the business. That could be increased, that could be decreased, but it really is a case by case scenario, and there's no general pattern that we tend to follow on that front. I guess what's most important is for us at least as owners, is to have the seller financing paid off, so that the seller, or as buyers, we want to be a really good buyer, so we want to pay the seller on time when it's due and so on. And if you start paying yourself dividends at some point, it just doesn't there's a misalignment of interest there. But what I would say is just if you were to own the entire business and you didn't have any debt and you wanted to enjoy yourself, at that point we just make the decision to pay ourselves. But it really does come down to a case by case scenario. So there's no strict, I guess, formula that we use. Let's put it that way. Anyway.
And I think it depends what industry you're in. So, for instance, you do a lot of asset financing probably, but I mean, you're looking at more service-based businesses that starts leveraging cash flow financing. Generally, cash flow financing will look at profits less dividends. Actually, when they give you the cash flow funding, so they'll look at average 3 times the profit less dividends. So they do look at that at cash flow funding. I don't know about every lender does, but I know a typical lenders would. So
yeah. And do you guys work with lenders as well? Do you help buyers finance the deals? So like, do you look for lending options, or do you work with other providers in order to get that funding sorted yourselves?
Yeah, so we're not FCA registered, so we don't provide the funding, but we've got a lot of connections to get financing. I mean, we're going through our own funding round now ourselves for our own business. We do a lot of pitch decks, as you might call them. I mean, pitch decks can be a bit controversial. You do need one. You don't need 100-page one, but you do need to understand what you're doing. So we do a lot of funding for people. I help them build the cash flows, the pitch decks, and the story around it, I suppose, is the most important thing, because most people are buying into you really as the business, because the numbers are what they are. They can change. Do they trust whoever's going to have it can run it? And I speak to a lot of funders, and I know the problem with funding that they always tell me when they get the pitch decks is no one's prepared. They think just giving them a P&L and the 5-year forecast is going to be enough. And when they start challenging the numbers, whether this is a business or a buyer, it's the same problem. They can't explain it. It puts you on the back foot right at the beginning.
Yeah, that's so true. So where we've got right now, as we speak, we've got 9 companies on heads of terms, and before going to the financiers, we create a business plan, we create the projections, we create different scenarios, and not only that, but we actually defend those scenarios. So it's kind of like each line item that you create within the projected P&L, right? You kind of need to be able to defend it. So for potential buyers that are looking at buying businesses, I think that's so important before even going to the banks. I think, I'm not sure what you think about this, but also buying profitable, well-established businesses, in my opinion, is really, really important. So most of the times, if you look at distressed deals, there's a reason why they're distressed. Most of the times is because obviously the market may have changed, that the cost of materials may have gone up or whatever. But a lot of the times it's because of the people within those businesses. So you're buying into a business that may not have the appropriate people to run it. And that just makes things a lot more complicated. Whereas if you were to also look at what succession plan you would have in place post the business owner, say, leaving the business, I think you would, you would save a lot of headaches. Let's put it that way, moving forward.
Yeah.
So yeah.
I think it depends where you are in your journey and what you're looking for. So, like, as an example, there's lots of different reasons people do acquisitions. They either do it to get access to resource, like to skilled labour, access new markets, access supply chains. So, like, as an example, let's just say, I don't know, you've got a garage and you could build cars and you don't have the machinery to build cars. You don't have to do a share sale. So you might find a company in administration that's distressed, that's got the machinery to build the cars. So therefore, your company's fine. And actually, there might be an opportunity just to buy the assets. So it might be you don't actually need the customers in this scenario. You just need access to the assets to help you improve your mix of services. So therefore, it doesn't matter if the business is distressed. You're actually going to get a good deal because you're just going to go and buy the assets you want. And a distressed business will sell assets, because they haven't got a choice. They need it. So there is opportunity with distressed businesses.
Yeah, totally. In those cases, there's totally an opportunity. In fact, we've gotten a deal done for a company that we're building in the food and beverage space. So the company was going under, and we took over the assets and also the contracts as well. So contracts would be really valuable moving forward. So we bought the contracts and the assets of the business, added to the UK Salads Limited, holding company, and it's added about 10 million in additional revenue just from taking a company that was going to go under liquidation and just working out a deal with the owner. So totally, there's a lot of opportunities there. It's just what are those opportunities for, right? And do you have something in the back room for those distressed deals? to make
They
sense.
work well I think they work well when you bolt on. I mean, we've just done it ourselves. We've just done an asset sale in our own company. You know, we had
Okay.
opportunity. We transferred the staff and we bought the clients. We basically changed it from about we probably went up 15 percentage points in margins. So we had no overhead, so no offices because we're virtual. Minimal insurance increase because ours is based on risk of payout, not number of clients. We got better partner rates with systems because you get a lower, the more licenses you have. Because of the services we offer, we've bought a book of clients that have got a certain level of there's a certain clientele that need the acquisitions and the exit planning. So that's how we leveraged an asset sale. So we did an asset sale, not the share sale. That's how we leverage it. We probably increased, I mean, we've only had it for 3 months and we probably already increased 15 percentage points just from the economies of scales from the sale.
Yep, totally. That's also something to add to the projection. So like economies of scale and group buying power, right? So if you were to, it just kind of makes sense, like just by itself. But if you can buy in bulk, or if you can buy in bulk, subscriptions, or you can buy in bulk materials, obviously that normally lowers the cost of purchase, and you could also project that into the future cash flows, and it also increases the profit margins, right? So it's totally something that to also consider, not only risk factors but also opportunities, right, moving forward when acquiring businesses.
Yeah, absolutely. I mean, that is the biggest benefit, isn't it, of buying businesses, is once you get bigger, you have more opportunity to reduce costs, because once you start buying in bulk, everybody knows, don't they? If you had 6 different insurance policies, it's going to be more expensive than if you have one group insurance policy. Everything becomes cheaper in bulk. And that goes for funding. Typically, funding is harder for smaller deals. When you go above 5 mil funding, it's much easier to get it actually than it is to get the lower amounts.
So that's one of the biggest lessons that I've learned in M&A. It's easier to get bigger deals done than it is smaller ones. Like the management teams are a lot more professional. They understand the commercials of getting a deal done. Then you go and talk to banks. Banks would rather lend you 5 million than they would say 200K, because for whatever reason, there's a lot of factors obviously, but they see you as a lower risk profile if you're raising 5 million, because you've got probably more cash flows you've got better projections, you've got more assets, you've got a lot more things in place so that they can have a better security option over the lending terms. And it's one of the biggest lessons that I've learned over the last 4 or 5 years. It's easier to get bigger deals on than it is smaller ones. So that's so true in my experience as well.
Yeah, it's definitely true. Yeah, it is. So I mean, I could talk about this all day. We're coming towards the end of the podcast, but one thing I would be quite interested to know is, so have you come unstuck with cash flows in any of the acquisitions for a reason? Like, had cash flow difficulties?
Yeah, so it's part of running businesses. You've got all kinds of difficulties. Sometimes that's just the cash flow, right? Some others it's just, I guess, but there's all kinds of problems that come as part of running a business. So when we come across cash flow problems, there's different things that we tend to look at. Okay, so we look at increasing the cash inside the business by negotiating debtor and creditor terms, right? So if you get paid earlier and you pay later, at some point that's going to increase the cash within your business. So that's something that we definitely look into. We also look into maybe renegotiating any payment terms that we may have. So maybe we owe, say, 100K in March, right? Well, can we renegotiate with our supplier, say, 250K payments within 90 days? Is that something we can do? A lot of the times they're willing to do so, especially the opposite as well. So maybe they're paying you, say, within 2 months. Can they pay you this month an extra amount for, say, a discount on whatever they're purchasing? So those are things that we also look at. And then also you've got additional financial instruments that you can use in order to have more access to liquidity, right? So one of them could be a invoice facility that you raise against the debtor book. Another one could be just a finance facility that you can have access to as part of just having a bit more liquidity to play around with. Obviously, all of this stuff costs money, right? But if the cash flow problem is for, say, March or February or January, and you can get those facilities in place, well, that just gives you, more oxygen to play around with. But obviously, you've got to be careful with the cost of having access to that finance facility. But yeah, those are things that we try and utilize in order to mitigate with those situations that always come up. So we've got a lot of instruments in place.
Yeah, sounds good.
Yeah.
I find what I think is people are too quick sometimes to get the financing. I mean, we've gone into businesses and turned about 150 grand of cash around in about 4 weeks, just from internal changes, like the debtor and creditor days, but maybe more advanced thinking. So my experience, people work well on invoice financing if you're in an industry where typically suppliers are getting long payment terms. So if suppliers are giving you 90-day payment terms, that's where you want your invoice financing because you can draw the cash down. However, sometimes we've seen it, actually, well, why don't you just change your mindset and ask for deposits? You don't have to have invoice financing. That is a way, but it's not the only way. And people are this is why, the cost, people will sometimes say, oh, I haven't got the money to invest in the finance team to do it. But I'm like, but the cost you're going to pay of the invoice financing over the next 5 years is going to cost you more than investing in your finance team, because actually deposits cost you nothing, really, apart from a better bookkeeper and a better finance and a better cash flow. Invoice financing. So invoice financing is a great for we've helped people sign invoice financing because there is a need for it, but it's not the only option. And I don't think people are thinking strategically enough about their own internal operations.
So true. I was just looking at it financially, but I mean, if you look at it strategically from a commercial point of view, at any point in time when you look at closing a sale, right? So let's say we sell about 75 million worth of caravans right now at this point. So what can we do in order to increase the purchase value at the point in which we sell a caravan? So we could look at insurance, we could look at awnings, we could look at accessories, we could look at TVs, we could look at all kinds of new products that we can add to that bundle of not only selling the caravan, but also selling products around the caravan. And if you can do that, obviously that increases the cash position within the business and also improves the cash flow, position moving forward. Those are things that maybe strategically you can think about. Maybe you're selling, say, a finance function within a business, but then you could also sell a legal function with just a JV partnership with someone else. So those are just ways in which you can creatively think through how to increase the cash position within months in which you may be struggling with that cash flow, right? So there's a lot of things that can go into it.
Yeah. All right. Wow. I mean, I could talk about this all day with you because it's really interesting. But as we're coming towards the end, I suppose one thing to ask is, so overall, what's your end game? Do you have one?
Yeah, I do actually. So I've got pretty big objectives, or pretty big goals. I'm 25 right now. I love this game. I love M&A. I think it's really, really entertaining, very mentally stimulating, I would say. So I see myself doing this for the next decade, to be honest. I would love to be able to build our group to £1 billion in turnover plus. I don't see why we can't do it, but I feel like we're going to be looking at expanding internationally in the US, in the UK, in Australia, also in Canada as the main markets, and just keep on doing leverage buyouts with a few exits along the years, and just enjoying the process, to be honest. I can go into a lot more detail about what my vision is, but I'll leave it there.
Yeah. All right. So, I mean, is there anything particularly, is there should people contact you if they've got certain types of deals? What are you looking for?
I mean, we're looking at asset heavy companies with turnovers in between 3 to 50 million in turnover in those main markets. And if you have any questions or any doubts or anything I can help out with, we're always keen on partnering in deals with people. You can find me on LinkedIn at Mathew Wainwright. If you just search for that on LinkedIn, you'll be able to find me. And always keen on helping people out and seeing whether we can get a deal done together. So you can find me online there. Yep.
Brilliant. Well, thanks so much, Mathew. And I just want to say thanks to everybody who's listening. I'm so excited. We've actually just gone over 1,000 downloads. This is our 14th week, and we've just gone over. Now we're at about 1,100, I think, but we was at 1,000 downloads. So,
wow.
So if our guests love, the show, obviously there's a lot of traction. We're getting a lot of downloads. So hit this subscribe or leave us a rating and review, because we'd love to have comments and people who'd like to come on the show. And I will see you again soon.